Welcome to Multifamily on Zoom. Everyone, as always, this is a space where we come together to learn, grow, and expand how we think about building wealth. Today's conversation is a little different because we are not just talking about investing, we're talking about how money actually works. Most of us were taught one way: work hard, save, invest, and hope it grows. But what if there's another way to position your money, as a way to create more control, more flexibility, and more intention around you build wealth? That's what today is about. Be excited to welcome Erica Neal from Infinity Investment Strategies, who's going to walk us through the concept of infinite banking. I'm not sure if you guys are familiar with that concept. It's been around for a while now, a strategy used by many wealthy families to build and preserve wealth over time. Erica Neal, we really excited to have you here. Thank you for joining us today.
Thank you. I'm excited to be here. Great introduction.
Well, go ahead, Erica. Tell us a little bit about you.
Absolutely. So I have a slide that I'll talk about myself and my team, but like she said, my name's Erica Neal. I'm co-owner of Infinity Investment Strategies. We are infinite banking practitioners, so we are licensed and certified in this strategy. And we're also real estate investors and business owners. So one of the big, and we'll get into the infinite banking, and we were talking before we started. I know everyone might be different on where they are in the understanding or the learning of the infinite banking strategy. So today I'm going to start at level 101. We'll start very foundational and of course answer questions from there. But before I get into that, we are specialists in IBC, but also we're real estate investors ourselves. And I think that's probably one of the biggest pieces of feedback that we've gotten as far as, there's people who understand infinite banking, there's people who understand real estate investing, and we understand both. And so, what we're going to talk about, and one of the big value adds that we try to bring, is that bringing both of these strategies together to help amplify the returns that you're getting while protecting your wealth and creating it to be generational and tax efficient, all of the things. That's really our focus, and I'm very passionate. I also talk very fast, so I'll do my best to slow down. But I just get very excited. So I'm excited to go through this. I've got, like I said, some very foundational info to go through to introduce you to the infinite banking concept, and how does this strategy specifically relate to infinite banking. So yeah, that's what we'll talk about.
Guys, you need to stay in the chat and be engaging. I'm posting something right now. How many of you have heard of infinite banking before? Please say yes or no in the chat. Go ahead, Erica.
Perfect. So infinite banking is this idea, and I'm going to go ahead and share my screen. Awesome. Looks like Jean has heard of it. So infinite banking is really it's just an efficient way to create your own private bank account. So instead of having all of your cash and your savings go into a 401k or an IRA where, my joke is that the R in IRA stands for restriction, right? You can't do this, you can't do that. So you're really restricted with the use of your money. Or if you put it in a bank account, the bank is making more money on your money than you are, right? So we really kind of fall into this pigeonholed situation. So the concept of infinite banking is we're going to maximize the IRS tax code. And if you really want to nerd out, it's tax code 7702. But we are using specially designed cash value life policies that are focused on the cash value instead of the death benefit. Because most people think, oh, well, wait a minute. Life insurance is if I die, my family gets money. Well, yeah, but it's kind of like a house. Think about when you buy a house, you can build up equity inside of that asset. Same thing with these policies. You have equity and cash inside of these policies that you can store and use that cash anytime you want. And today we're going to specifically talk about using that cash to build wealth through real estate. We're going to talk about some of the challenges that we face in the wealth building process. And when you incorporate infinite banking, what benefits do you receive from that? So we're using all it is a life insurance policy that's focused on the cash value, not so much the death benefit, but specifically using that cash value to go out and invest in real estate or business. So that's really what we're going to focus on. And like I mentioned, I've got my wonderful team. They are just, I'm very, very blessed to have this group. My business partner and I, like I said, we are authorized infinite banking practitioners. You can go to infinitebanking.org and see the various infinite banking practitioners that are out there. We also have Lisa Morrissey. She is one of our wealth strategists. We have Brian Castillo. He is our service manager extraordinaire. And Eliza Mata is our new business coordinator. So we have a wonderful team of people. But specifically, just to kind of give you guys a little bit of background about myself and David, we come from the traditional financial planning world. And I was the more financial advisor, Wall Street, mutual funds. David did more of the stockbroker type trading. And so what we found is that in the Wall Street world, Wall Street is more focused on getting assets under management and chasing rate of return. And those aren't bad things, right? Those are good things to have, but there's a disconnect. They're not actually teaching people how to make their money work for them. Just because you have a whole bunch of money saved up in an account, how much cash flow is that 401k or that IRA or that stock portfolio? How much cash flow is that going to generate? They're not talking about that. So we ended up, I left where I was at the investment firm and David left his firm. I left my firm. We ended up meeting at a boutique firm in Fort Worth. And that's where we started focusing on cash flow strategies, utilizing different tools for different jobs. But anyway, after working alongside one another for a few years, he was doing real estate and infinite banking, as was I. We ended up branching off, launching our own firm, which is now Infinity. And now we specifically work with investors and entrepreneurs on understanding this strategy, building generational wealth, and maximizing tax efficient cash flow. And like I said, we've got a great team with a variety of experience. Now, when we talk about infinite banking, it's been called infinite banking, bank on yourself, be your own bank, right? We keep using this word bank over and over again. And so the idea is if we want to become the bank, then we have to understand how banks make money, right? So if we understand how banks make money, we can recreate that system to your benefit instead of theirs. So I don't know if you guys are familiar with this, but I'm gonna throw a couple of trick questions at you. Let's say that you come to me and deposit money with me. If I'm your bank, is your deposit, is it my asset or is it my liability? The deposit by itself is a liability. The banks are liable to pay that back to you. Now, as the bank, all I'm going to do is I'm going to take your deposit and I'm going to loan it out to somebody else. And on the bank's balance sheet, a loan is considered an asset. So I bring this up because it's totally different than a consumer, right? So we have to, if we want to become the bank, we have to stop thinking like a consumer and start thinking like a banker, okay? According to a bank, loans are considered assets. And so again, that's a 180-degree turn than what we're used to. Now, why is a loan an asset? Well, Robert Kiyosaki, he wrote Rich Dad Poor Dad, and he describes it very well. Assets put money in your pocket. I am charging 7% on that loan, and I'm only paying you 0.2% on your deposit, right? Virtually nothing. So I am making money and paying you a little bit. This right here is called arbitrage. I am earning more than what I'm paying. Okay. Now here's the question. If I'm earning 7 and I'm paying 0.2, does that mean that I'm earning 6.8% on this transaction? No. 6.8% is only the spread. That only tells us the difference between those two interest rates. Let's look at this like an investment. Okay. If for every dollar you deposit, I'm paying you 20 cents and I'm earning $7. So imagine buying a stock on January 1st for 20 cents. And at the end of the year, that stock is worth $7. If you were to do that, that means that you got a 3,500% return. That is what banks are doing with our money. How? And I'm not even going to go down that rabbit hole. I can complain about banks all day. This is the same industry we have had to bail out twice, almost 3 times now in the last 12 years. And they're making these kinds of returns. They are making hand over fist significantly more money on our money than we are, and they still have to have bailout money. So when we really zoom out, we pause, we say, wait a minute, what's going on here? When we really look at this whole scenario, throughout this entire process, who has the most control, the most access to the money, and who makes the most profit the entire time? The bank does. We have handed them all of our hard-earned money and said, here you go. You can control the money. You have access to it to do whatever you want, and you're going to make more profit on it than I am. And what I'm here to say is no. We can become our own banker. And here's the thing, we don't need to recreate the wheel. The system works, right? This is a pretty good system. The problem is it's working for somebody else instead of us. So the idea is instead of the bank being in the middle, let's put you in the middle. So now you can be the one to have the most control, access, and profitability of your own money instead of giving it away. Okay? Now, how do we go about doing that? Well, like I mentioned, I come from the traditional financial planning space, and that world is very much a my daddy can beat up your daddy world, right? Like everyone's always better than the other guy. Don't do this, don't do that. And really, my philosophy is that there's no such thing as a good tool or a bad tool. There's just different tools for different jobs. So if you try to cut a piece of wood in half with a hammer, we can't get mad at the hammer and be like, ugh, this thing's not very good. No, we're using it wrong. So when it comes to your money, we need to figure out what job are you trying to perform, and then what's the best tool suited for that job. So with money, there's three functions that you needed to perform. You have short-term needs, intermediate-term needs, and long-term needs. That's it. All of the things that we need fall into these three categories. Now, short-term is pretty self-explanatory. That's gonna be a bank account, right? We can't get rid of these guys just yet. They do serve a purpose. Now, with a bank, most people are putting money into a bank to get some level of safety, right? Like I always put that in quotations. But it's also liquid. We can go to the grocery store, we can pay bills, we can do things that we need to do. The catch with a bank account, though, is that there's really not much growth. So this is money you need to use within the next year. Otherwise, you're going to lose money due to inflation. We don't want money sitting there, okay? On the other end of the spectrum, though, we have the investment category. Now, this is very, very broad. This can be real estate, stock portfolios, businesses, 401ks, whatever. Something that over the next 7 or more years you are hoping will come to fruition. We are hoping to see some level of growth. Now we have to acknowledge hope is the key word here because all investments carry risk, right? That's just what we've seen. We also know that when we invest in something, that money is not typically available. Usually it's tied up for at least a given period of time. So this is the dynamic that most people, but specifically entrepreneurs, are really faced with. If you want safety and liquidity, you have to sacrifice growth. And if you want growth, you have to sacrifice safety and liquidity. So you can either put your money into an account where you need to use it within the next year, or you can lock it up for 7+. That's a huge gap. I can't tell y'all how many times I've talked to somebody that's saying, you know what? I've got cash sitting on the sidelines, but I haven't found a good deal yet. I don't know where I want to put my money. I'm tired of it sitting in the bank account, but I don't want to lock it up because there might be a good deal come my way. I need to be able to get to that money fast, but I still need it to earn, right? So how do we bridge the gap between your everyday bank account transactions and your long-term investments and fill in the holes here, right? So we don't need, this is like having a hammer and a saw. We need something completely different with different characteristics to fill in the gaps here, like a screwdriver, okay? So we want to give you the ability to earn guaranteed growth, more than what you're getting in the bank. Your money is going to be safe, so when you go get it, it's there. It's liquid, quick and easy to access. You're going to have some tax benefits. You have control over the money going in and out, and it's completely private and protected. I'm really going to harp on that in a minute. But the key here is this is why we refer to these policies as the vault. So think of a vault or a safe in your garage or closet or whatever. You don't have to tell us where you put your vault. But you can put money in when you want. You can take money out when you want. It's safe, it's secure, but here's the key. Who knows how much cash you have sitting in your safe at home? Just you, right? It's private. Nobody knows. So that's a key element of these policies. I'm really going to harp on that later. But again, this isn't to say that one is better than the other. Absolutely not. This is saying now we have our hammer, saw, and screwdriver, 3 different tools performing 3 different functions of your money for you. Now, how do we recreate the banking system that we just saw, but to where you're in the middle, not the bank? Okay, here's how this works. You take money out of your bank and you deposit it and save it into your vault, okay, your IBC policy. You are then going to take a loan against your policy. You're going to loan that money out into a cash flow investment. And the investments that you receive, the cash flow is what you use to pay that vault loan back. I have an example of that later. But you're loaning against their policy, you're investing it, you're taking the cash flow from those investments and putting it back into your policy, but you're going to earn more from your investments than what you're paying into your policy. So guess what? Now you have money left over that trickles down into your bank account. But now guess what? Now you're too liquid again. So you need to put more money into your policy so you can do more investments, and then you just rinse and repeat this process over and over and over again. So we don't want our money sitting stagnant like stinky pond water, right? We want it moving, right? Robert Kiyosaki talks about the velocity of money. I like to call this the flow and grow. I think about a roaring river, right? Like making movement. That's what we want our money to do. And yes, if you can't tell, there is some subliminal messaging. That's exactly what we do. And so I emphasize this because we are not transactional, right? This isn't something where we say, oh, hey, here you go. Here's an IBC policy. And then we smack your butt, you're out the door. Absolutely not. We're very focused on education. We have a whole educational process that we walk people through, but then we customize the policy to fit you where you are. We give you the ability to grow it over time. But more importantly, we're helping our clients figure out, where do we need to put this money? What investment? Oh, if I invest in this, what does the cash flow loan need to be? We're going through the analysis and creating these cash flow systems so that you have the consistent velocity of money. Okay. Now, when we look at this list right here, all of these characteristics, the only asset that actually checks off every single one of those, that is why we are using these life insurance policies that are issued by A-rated, mutually owned, dividend-paying companies. So we're very, very picky about the type of company and policy we use, because if it's not set up right, it's not going to work right. Okay. And so with these policies, we need these guarantees built in. The first one is your death benefit. Now, everyone's different. Some want a little, some want a lot. Doesn't matter. We work with people individually. The point is you've got one and it's going to grow over time. Your premium is also locked in. Y'all, this is the only policy that guarantees your premium remains level no matter what. If you get old and well, when we get old, right? It doesn't matter. They can't charge you more in the future. It's locked in. You also have a guaranteed cash value that will increase every single year, regardless of what the stock market does. Completely uncorrelated. Now, there's two non-guaranteed elements to this. And the first one is your annual dividend. So we are using mutually owned companies, which means not me, not you. Nobody can buy stock in these guys. They don't have an 8-figure CEO. When you own a policy, you are a mutual owner. You're a part owner in the company. And so at the end of the year, when they pay their dividend, you're entitled to that. Most people just have it reinvested back into the cash value to make it grow even faster. Okay. Now, again, they're not guaranteed, but the companies that we use have been around for over 120 years and they've paid a dividend every single year since their inception. So take that however you want, but they're not guaranteed. Wink, wink. The other part of this that's not guaranteed are your cash dump-ins. Think about your house, okay? You know what your mortgage payment is on your house, right? Can you pay over and above your mortgage to build up your equity faster? Well, sure. But are you obligated to do so? Absolutely not. The same thing goes with these policies. You know what your premium is, then you have the ability to put additional cash over and above that to accelerate the cash, and it's completely optional. Okay. Now, what we do is each piece of this is customizable. Everybody's different. So we work with people one-on-one to do that. This is just high level what's happening inside of the policy. Okay. Now, infinite banking is a plug and play, meaning I would never tell you, hey, give me all your money. We're going to put it in this life insurance policy. Don't go invest. Don't go, right? Like that's ridiculous. You would laugh in my face and walk away, as you should. But like we just saw, infinite banking becomes a flow through account. It's a yes and. It's not an either or. So when you take infinite banking and you plug it into what you're already doing, there are 4 key areas of benefit. What I like to call the 4 pillars are the benefits that you start to experience from infinite banking. And the first one is lower taxes. We always love to talk about lower taxes, right? Now, I'll tell y'all, I come from the retirement planning space and I saw more people in retirement paying more in taxes than they ever did while they were working. Why? Because all they did was defer, 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 defer. They maxed out their 401k, they put all this money in their IRA, and they got slapped with a major tax bill 10, 20, 30 years down the line. I am not about tax deferrals. I'm about tax efficiencies. I've seen it, I've lived it. I don't want to have to do that anymore. I'm here to help people change that narrative. Now, one of the number one questions I get with infinite banking is, can I take depreciation? So I know a lot of you guys are doing multifamily. Guess what? Bonus depreciation and cost segregation is back up to 100%, right? We get all the depreciation. If you invest with an IRA, you don't get any depreciation. If you invest with your IBC policy, you get full depreciation benefits. You also, we just saw, you're putting money in the policy, you're also getting guaranteed growth plus dividends. You're able to use your money and the growth completely tax-free through the loan strategy that we're going to look at. Now, when you borrow against your policy, you're taking a loan, which means you're going to pay simple interest on that loan. Again, I have an example here shortly. When you pay interest on your policy loan and you use it to invest in real estate or a business, that becomes a business expense and you can write it off as a tax deduction. Okay, so that's one more way to do a straight line deduction. Now let's fast forward because I think we're all doing the same thing, right? We're all trying to build up as many cash flow assets so that one day we don't have to get up and go to work. We become work optional, okay? I don't know about retirement, but we just want to sit back and collect mailbox money. These policies are no different. One day in the future, you call me and you say, "Hey, Erica, I don't want to put money into my policy anymore. I want it to start paying me." And I say, "Cool, we flip the switch and it will spit out a guaranteed tax-free income to you for the rest of your life, just like your own personal made pension." So this is the historical tax rate. This is where the federal income tax rate was when it was put in place in 1913, and this is what it was in 2025. Y'all, we are in one of the lowest tax environments that we have seen historically. Look at this. Do we really think tax brackets are going to go down over the next 10, 20, or 30 years? I don't know, but I don't have a positive outlook on that. I expect tax brackets are going to go down. So we want to be able to take tax deductions now, but also have tax-free income later. And that's exactly what these policies do. There's also no UBIT. So anybody that's used a self-directed IRA is familiar with UBIT. IBC policies do not have any of those. And then you have a tax-free transfer of wealth. This is the most efficient way to transfer wealth from one generation to the next. There's no inheritance tax, no estate tax, no wills, no probate. There's a great book called What Would the Rockefellers Do? Which I think they know a little bit about generational wealth, right? They have used life insurance policies for cash flow banking and to protect and maintain generational wealth for literally hundreds of years. So there's a tax efficiencies on the upfront and on the back end. So we want to have a balance of that. Pillar number two is control. And let's be real, y'all. I don't know about y'all. I'll speak for myself. I've got some control issues. That's why I don't go clock in for somebody else from 9 to 5, right? Like I want to control my own time and do that. And you guys are obviously doing the right thing, coming in and doing this on a Saturday. So you're very dedicated. So I don't like the idea of giving control of my money to somebody else. When you become your own banker, you make your own rules. One of the number one questions I get is, "All right, Erica, this sounds cool and all, but how easy is it for me to get my money?" Well, you can take your money out as a loan or as a withdrawal. It's up to you. We are going to focus on the loan for the banking strategy, but there's no questions asked. None. Actually, there's two questions. They're going to ask you, how much do you want and where do you want it sent? That's it. Has anybody, if I'll save time, but go to the bank and try to take out more than $10,000 cash. See what hoops you have to jump through, right? You've got to sign this form, get the blood of a bat, eye of an eagle, all that crazy stuff, right? It's a pain. It doesn't matter with your policy. Who, what, when, where, why, doesn't matter. There's also no surrender charges. No surrender charges, no vesting fees. And when you take these loans against your policy, you decide how, when, and if you pay that back. You control that. On the funding, it's completely up to you. How much does this thing cost? However much you want to put into it, okay? You decide your savings level. You have the ability to put additional cash, like we talked about. You're funding extra cash into your policy. And what we show you is not only are the cash dump-ins going to your cash value, but also your premium is increasing your cash value. We design it so that your money is working for you. And then lastly, these companies, they're guaranteed to grow, not correlated to the market. They're very reliable on their dividends. They're A rated and they have incredibly accurate projections. So we're not just throwing stuff at the wall to see what sticks. These companies are hitting their targets year by year. Now let's talk about the risk factors. We've talked about all the bunnies and rainbows. We need to talk about the reality that there are multiple wealth eroding factors that are threatening us and our money. The first one is market crashes. So again, like I mentioned, these policies are guaranteed to grow. When the market's up, your IBC policy's up. When the market's down, your IBC policy is still up. Here's the thing. When does most buying opportunity tend to present itself? When the market's down. So if your cash is tied to the market, you're going to have to lock in losses. We don't want that. These policies are always on the up, so you're protected. You're also shielded from creditors. Now, this is going to vary state to state. I'm in Texas. I know, Susie, you're in Tennessee. So it varies state to state, but most states offer 100% protection from your cash from being seized or levied by creditors. You're also protected from bank runs. Y'all, we have seen little bank runs here and there. We haven't seen a federal national bank run, and I hope we never do. But there's two things we need to acknowledge. Right now, most people don't know this, but March 15th of 2020, the Federal Reserve lowered bank reserve requirements to 0%. We are in a 0% reserve requirement right now. Every dollar that you deposit, the bank can lend right back out. And people ask, are these policies FDIC insured? Absolutely not. We only use A-rated companies. FDIC is a joke, and here's what I mean by that. FDIC insures up to $250,000 per person per bank account. So if, God forbid, the bank were to go under, the FDIC will reimburse you that $250,000. The FDIC has an account called the DIF. It stands for the Depository Insurance Fund. This is their reserve account. This is the FDIC's bank account, essentially, that sits there so that they can pay all of the liabilities that they insure, because they insured like trillions of dollars, right? What percent of the money do you think they actually have in reserves compared to what they're liable for? It's 1.13%. The FDIC has 1.13% of the money that they insure actually in reserves. Imagine buying a $300,000 home and then insuring it for $3,000. The bank would flip out, right? They would say, absolutely not. But that's exactly what they're doing with your money. When I say A-rated companies, we only use A-rated companies because they are required to get that A rating. They're required to have a minimum of 100% reserves on hand for every dollar that's guaranteed. There's no other financial institution held to that kind of standard. And then lastly is predators. This is a sue happy world, right? Unfortunately, we live in that space. So God forbid you have an angry investor or a clumsy tenant or God, y'all, I have a 17-year-old daughter, knock on wood. If she were to rear end somebody and their neck hurt a little bit too much, they're suing me, my house, my car, my dog. They're suing everybody. But I'll tell y'all, my cash is protected from being seized by creditors or predators. So we have LLCs and trusts. We've got all that, and that's wonderful. These policies are one more firewall to protect you, your family, and your assets. Now, let's get back to the good stuff. Let's talk about leverage. So how can we maximize your real estate returns? Well, let's say you need to do some sort of financial reporting. You're going to go talk to a bank, or you need to show that you're an accredited investor, any of those things. You get to use 100% of your IBC cash value towards your liquidity or net worth on your PFS. I'm buying a business right now, and I'm going through the SBA loan process. I'm using 100% of my cash value in my policy to show liquidity on my SBA. I had a client this week, they're buying a house, and their lender called me and they needed proof of funds. I sent them a statement of cash value, they got 100% credit, right? So you get to use that. Now, let's say you don't want people to see how much money you have. Like I said, my oldest daughter's 17, she's a junior. She's going to be a senior in high school next year. We're going to be starting the college planning conversation. When she's filling out the FAFSA, scholarship applications, all that, anything that I have will hurt her chances of getting approved. For FAFSA and scholarships, Roth IRAs, I don't even fund 529s for my kids anymore. Bank accounts, all that hurts her chances. I do not have to disclose a single dollar inside of my IBC policy. So I can use it to help her pay for school, but it won't hurt her chances of actually getting approved for those programs. Now let's talk about arbitrage. Remember the very first thing we talked about with how banks make money, right? They pay a little bit and they go earn a lot more. When you take a loan against your policy, the loans are not reported. We are also using non-recognized loans. Now, what does that mean? That means that you're going to continue to earn compound interest on your money even when you take it out of your policy. Okay? And remember, there's a difference between the interest rate spread and the actual rate of return. Remember how we talked about the interest rate spread versus the rate of return of how banks make money? So here's what that looks like. If you have like a bank account or an IRA or something like that, and you want to, let's say you have $100,000 saved up and you want to take out 70, you take out the 70, you invest the 70, and you go get whatever rate of return you get, right? Y'all know what you're doing. That's great. Any cash flow you get from that investment, what do you do with it? You resave it into your bank account, right? And all the while you're earning interest on the 30,000 left over. Pretty cut and dry. That's day-to-day stuff. But if you have become your own banker, it works a little bit different. You still have that 100,000, but this time when you take out the 70, you take it out as a loan. And you're going to pay simple interest on that loan. You go out there, you get the same rate of return, the same depreciation, all that. The difference is when you get cash flow from your investment, instead of putting it back into your bank, you're going to put it back into your IBC policy. And the entire time that you've been doing that, while you've been getting a rate of return, you're still earning compound interest and dividends on the full $100,000 value. Now, this is where people say, whoa, 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 Erica, wait a minute. So if I'm paying interest and earning interest, like how does that work, right? Like, doesn't that reduce my return? Well, let's look at it. We need to understand there's a difference between money and math. We are taught our entire lives to think math, linear. Money works a little bit different. Now, I'm going to give you guys this example. This is an extreme example. These are not real numbers for a policy. I'm just using this to demonstrate the difference between earning compound interest and paying down interest, okay? So if I say, hey, if you put $100,000 in this account and I'll pay you 4% a year over the next 5 years, the only catch is you have to simultaneously take out a $100,000 loan and pay 6% interest over the next 5 years. Why would anybody take this deal? That's dumb, right? If I'm earning 4 and paying 6, the spread is negative 2%, right? But remember, that's math. Let's look at the money. If you took out a $100,000 loan at 6% interest and paid it back over 5 years, you would have paid $15,420 in interest. And you can see that number way down there. It's a little bitty. And this is where I have people say, whoa, whoa, whoa. They throw their hands up like, see, this is stupid. Why would I pay $15,000 in interest when I have the cash sitting right there? I could have just used the cash and paid 0 in interest, which is true. But you only have 2 options when it comes to your money. You either pay interest or you give up the ability to earn future value interest for the rest of your life. So the entire time, yes, on this loan, on the policy loans, you're paying policy interest. But remember that $15,000 is a tax write-off, so that depends on the person and their tax rate. But what's been going on for the last 5 years at the same time? Your $100,000 has remained undisturbed, and let's just pretend it only earns 4%. And I can tell y'all right now, my policy's earning more than 4%. But even if it only earned 4%, over 5 years, I've accrued $21,000, almost $22,000. So you paid $15,000 in interest, you accrued 22. Now, let's pause for a minute. Is infinite banking, is this the best rate of return you've ever seen in your life? No, absolutely not. This is called infinite banking, folks. This is not infinite investing. I'm not talking about earning a good rate of return inside of a life insurance policy. What I am saying is earning a good rate of return in your investments, whatever you're invested in your multifamily deals, and getting an arbitrage on your money at the same time, while getting additional tax benefits, while getting additional tax write-offs, while getting asset protection, and while getting a legacy all in the same pack. So again, this is an extreme scenario that you're paying 6 and earning 4. I took out a loan 2 or 3 weeks ago and my loan interest was 5.1%. So this is an extreme scenario, but I want to demonstrate there's a difference between earning interest and paying down interest. Okay. So again, infinite banking is not about getting a great rate of return. It's about going out and getting a great rate of return in your investments and in your real estate while you continue to earn an arbitrage spread on the inside. And you're maintaining control of your money the entire time. So we'll stop here. We'll wrap up. It's very common. I get the question, if this is so great, why have I never heard of this? Right? Like I've never heard of this before. Why isn't everybody doing it? Well, here's my challenge to that. Who's your everybody? Right? Who are we talking to? Is it the guy down the street that has a subscription to Forbes magazine and he's maxing out his 401k? Is that who we want to be? And nothing wrong with that guy, but it's do we really want to recreate that financial situation for ourselves or for our family? Or do we want to look at some of, and I don't like wealthy, I don't like that word because that's relative, right? Financially mature people and what they've done with their money. So there's a couple of examples here of how infinite banking has been used, and a lot of people don't even realize it. Rockefeller Center is the largest privately funded construction project ever built. During the Great Depression, Rockefeller wanted to build this thing, couldn't get a loan from the bank. So he fully funded Rockefeller Center with his personal cash value life policy. Walt Disney, he had a movie company, but he wanted to start a theme park, couldn't get a loan from the bank. So the first money ever put into Walt Disney World theme parks came from his life insurance policy. Doris Christopher, she was a home ec teacher in the 80s. She wanted to start a cookware company, couldn't get a loan. She took $5,000 from her policy and started Pampered Chef and then sold it for like 1.6 billion just a few years ago, like a crazy number. Foster Farms is the largest chicken producer in the state of California. They have used their policies to fund their business and maintain generational wealth. We see politicians all the time. Donald Trump, Joe Biden, John McCain, the Roosevelts, the Kennedys. All of these guys have used their money to fund their campaigns and for their own personal investment. So I have two schools of thought on this. Number one, if we want our money to remain safe and tax favored, we should probably put it in the same place that the people who wrote the laws put theirs. Just saying, right? And then my second one is my joke is if Republicans and Democrats can agree on something, it's got to be good, right? Like just throw that out there. And then if y'all get a chance, JC Penney's kind of our poster child for leverage. I recommend that you look up Boli Coli, Bolicoli. This stands for bank-owned life insurance and corporate-owned life insurance. The largest banks and corporations in the world hold a majority of their assets inside of these policies. Wells Fargo and Bank of America have 53 and 54% of their cash inside of a BOLI. But if you go talk to one of their advisors, they'll tell you to buy term and invest the difference. And I can tell y'all right now, 2020 to 2021, BOLI deposits increased over 14%. Banks are funneling money in here left and right. J.C. Penney, during the Great Depression, they're a retail store. Obviously, they're not making any money. They took a loan against their corporate-owned policy, and they used that to pay every single J.C. Penney employee throughout the entire Great Depression. And I love that story. I just think that's so powerful, right? And then lastly, OJ, I don't know if y'all think he did it or not, doesn't matter. He got some really good advice. He was told before all the indictments and before everything came down the pipeline to put as much money as he could into a life insurance policy, and that's exactly what he did. That's why when he got out, he was like golfing on Mar-a-Lago and doing all this stuff because he protected his assets from being seized in the midst of that lawsuit. So I am not condemning or condoning. I'm just saying that was some good advice, right? So that's that. We do have some free resources. Our website, infinityinvestmentstrategies.com. We're also on YouTube. We've got the Infinity, and I've got my own educational YouTube. I interview a client of mine every single month, and we do a deep dive into what their investment or their business is, just to help people understand all the different ways that you can put your policy to work. So I know we're crunching at the top of the hour. Questions, thoughts, feedback. I guess I know I went through that really quick. It's kind of like drinking from a fire hydrant, but it's really good info.
All right. Thank you, Erica. That was so good, y'all, wasn't it?
Thank you.
Oh my God. That also shows your passion about what you do, Erica. That was
Just a
great.
little bit.
Yeah. Um, and that's not my first time hearing it. And hearing it again, I was actually enjoying it. So, guys, if you have a question, just go ahead and put it in the chat. I think I see a couple questions people had earlier. Michelle, was that you? I think Michelle has a question, but Len says something about IRS code. She said, did you say the IRS code 7702? Did you mention that?
Yes, tax code 7702 specifically talks about being able to take cash and overfund a life insurance policy, and it refers to a what's called a MEC limit. So we can't put unlimited cash in here, right? They used to. Prior to 1988, you could. And then Uncle Sam caught wind of it, and he didn't like how much money he was losing on the tax side. So he stepped in and said, "Hey, you can put money in these things, but you can only put so much." And so what we do is we maximize the cash that we can put in based off of that MEC limit.
All right. The other question came from Michelle. She said, is there a target age to establish this policy?
I love that question. So the short answer is no. And a lot of people ask, am I too old to do this? And here's the difference between life insurance policies and IBC policies. Most people think, okay, well, life insurance, if I want $1 million, then I'm going to have to pay more if I'm 50 versus if I was 20, right? But with infinite banking, we're not talking about the death benefit. I don't think I said anything hardly about it today. We're talking about the cash value. So your 50-year-old self and your 30 or 20-year-old self can put the same amount of money into a policy. Will the death benefit be different? Yeah, the death benefit will be different, but your cash and the utilization of it will be the same. So, and the other thought of this too is if let's say you're in a position where you're like, you know what? I'm ill or I have something and I'm just physically uninsurable, then you can do it to where you have somebody like a child or business partner or spouse. You can put a policy on somebody else that you own and you control and you get to use the money, but you get to use somebody else's physical body.
All right, that is good. Let's see something else in the chat. Okay. Um, Somebody said that was my first question. Oh, that's Thomas. Yeah, you can ask your question. Open your mic and ask your question. I want that.
And
Instead of
I'm
me
really
reading your
glad
question.
Thomas, I get that
You see what
question.
he said?
Yeah, he says, can I roll over a 401k account into an infinite banking policy? What are the tax penalties or implications? Great question. So, yes, you can take money from a 401k and put it into an IBC policy, but it's not considered a rollover, okay? So, with that being said, when you take money out of a 401k and it doesn't, because IBC policies are not retirement accounts, right? At that point, you would have to pay any taxes and penalties. So the 20 to 25% in taxes and 10% penalties. Now, does it make sense to do that? I don't know. Sometimes, because if you invest with a 401k, and sometimes a lot of them don't even give you the ability to invest in real estate, but if they do, you don't get any depreciation. So people who have rolled over retirement accounts to their IBC policy, if they have taxes owed on that, they take the money from their policy and invest in real estate to get some depreciation and offset the taxes. Okay. Now, we don't want to roll everything over all at once because that's a big tax bill. But you can do it like on a year by year basis. I have a guy he's 52, 53, and he wants to be fully retired by 60. So we started every year. We're rolling over, I don't know, probably like 50 grand or so, 50 to 60,000 from his 401k into an IBC policy to keep him below a tax threshold. So you can do it all at once and then same thing, land, same thing with the SEP IRA. Any retirement account, if you take it out of there, it's going to have the taxes and penalties because these policies are not considered, they're not considered retirement accounts. They're a different asset class. And then Michelle, very creative. What if you did a loan against your 401k and put it into an IBC policy? Very, very clever. Could you do that? Yes. I would present that that might be a slippery slope depending on what the interest rate is for your 401k. Because now then we're going to have two debts if you use your policy to go out and invest. Is it impossible? No, but it may not always make sense either. We'd really have to do the math on that to see if it would make sense. Yeah, really good question.
Yeah, I agree
Very
with that.
creative.
Yes. One of my question is, what is the biggest misconception people have about money or banking that this strategy challenges?
Yeah, I think most people, not most, but a lot of people think infinite banking and these policies are only for the uber wealthy. And I could not disagree more. Right now, there are a lot of uber wealthy people that use these policies. They kind of use it like it's called the rich man's Roth because it acts like a Roth type account, but there's no income limits, there's no contribution limits. So my challenge is are the do is are only wealthy people the ones that use IBC, or are they wealthy because they use IBC, right? Is it chicken or the egg? So these are not just for um, wealthy people. And so I just saw that question come in, like, what's the minimum ideal investment?
Before we get into that question, Erica, I
Yeah,
think I have a question that has everything.
yeah,
Rather, how does, hold on, okay, how does someone actually get started with infinite banking? What are the first real steps? Because I think that question can go inside.
absolutely.
Yeah.
So the very first thing you need to do before you ever start an IBC policy is get educated. And I can't emphasize this enough. You need to understand the ins and outs, and I'll tell you right now, these policies, this is not a get rich quick. This is not a silver bullet. This is a long-term wealth building strategy. There's no free money, right? Just like when we buy real estate, we don't have 100% equity day one. These policies are the same way. You don't have 100% equity day one. So you really need to get educated and understand how the policy works, the loan, right? And then and we have a process we walk people through. When you fully understand it and you say, okay, I get the idea. Now I need to see what this looks like specifically for me. And you have to get approved. So there is an approval process. You submit your info. You do have to do like a physical, they do a blood and urine check. So you get approved by underwriting. And then at that point, the underwriter says, hey, maybe they approve you for $5 million. I don't know. Just because you get approved for $5 million doesn't mean you have to take $5 million, right? You just see what you can get approved for. And then you decide, coming back to that question, how much do you want to put in, right? I have some people that put in, 5,000, 10,000 a year. And then we have other people putting in seven figures. So my point is start at a level that you know that you're comfortable, and then you can grow it over time.
Okay. Jean Lafleur, you have a question. Go ahead. You raise your
Yes, I
hand.
do have a question. Thank you for bringing that subject on the group. Uh, when it comes to to insurance, now you're talking about age. Not everybody will be approved for this, right?
It depends. So honestly, policies can be, most companies will issue policies all the way up until like age, some of them are like 85, 88. Now,
You won't be able to pay for it.
exactly, right? Like that may not work on the cash value side. Like, does it work? Yes, but it's going to be slower. So, in those instances where somebody says, "Hey, maybe I am a little too old, or I'm just unhealthy and I have some sort of physical issue," when that's the case, we will say, okay, well, who is in your life that you have what's called insurable interest? Do you have a business partner? I have a guy who has like 11 grandkids, and he wrote a policy on every single one of his 11 grandkids, and he's doing that as a gift, right? Well, I have another guy who he's really old. He's like, I don't want to say really old. He's like 80 something, but he was same thing. He's like, I can't get a policy, but he has a guy that works for him that's like 45, young guy. So the business owner got a policy on one of his employees, used his physical person, but the business owner owns the policy, puts money in and out, so he just used somebody else's physical person while he continues to fund it.
And the insurance company has no issue. I mean, if the person is not related to you,
Yeah, if they're not related to you, you have to have some sort of what they call insurable interest. So
it's
he's an
whatever interest, huh?
employee, which is like, if something were to happen to him, he'd have to be replaced or, so they always look for would you have some sort of financial issue if this person were no longer around?
And what is the difference between uh, your banking and IUL?
So both whole life policies and IUL, which stands for Indexed Universal Life, both of them are permanent life insurance policies that have cash value. The difference is on these whole life policies, they're guaranteed to increase and they have the dividends every single year. IUL's cash value are tied to the index. So if the stock market goes up, your cash value goes up. If the stock market comes down, your cash value can come down. Now the thing with an IUL is it has a floor and a ceiling. So the floor might be 0, 1, or 2%, and your ceiling might be 9, right? So if the market does 15%, you get 9. But if the market crashes, you get 0. Here's the problem with that. Like I said, when is the most buying opportunities going to present themselves? Well, one, when the market's down, right? So if you're earning 0, but you borrow against your policy and you're paying, let's say, 5%, that's a negative arbitrage. That doesn't mean IULs are bad. Hear me out on that. I have written IULs. I'm working on one right now for a business owner client. The point that I try to emphasize is that if you're going to use an IUL, you have to acknowledge that your cash value is going to fluctuate. It's tied to the stock market, and IULs do not have a guaranteed level premium. So if you have this policy for 15 or 20 years and you've gotten older, they do have the potential to charge you more in the future. And that means that your cost can go up, which can reduce your cash value. So there's no good or bad tool. It's just that IULs have a lot of moving parts that we need to be aware of and tread carefully.
Thank you.
Yes, very good
All
question.
right. All right. Thank you so much, guys. It's 3 o'clock, and y'all know we have to stop right here. And if you do not have your camera on, please put it on. As you guys know, we always take a picture at the end. And let's take a picture right now. And again, if you're looking for something, you're looking for a partner for your business, you're looking for more education, you're looking, whatever you're looking, put in the chat where you located, your phone number. Erica, also, you do not, okay, that's what I was about to ask you. Put your information so people could reach out to you. You just did. Guys, this is Erica email in here, so you guys can reach out to her. And clearly she did something amazing trying to make you, but really she cannot do that in 1 hour. She, like she said, they really focus on education. So she have really to have different session with you in order for her to answer all your question and for you to have a better grasp of what IBC strategies are. So with that being said, you guys know what's going on. If you go into UP, let me know. Oh, I need to tell you about UP. Actually, it's in the back of it's in Dallas. It's May 15th. It's the IE Mentor Conference they do every year. I don't know if you've been to that one. So it's
I
gonna be
haven't.
in Addison this year. So if you guys would like to have a booth, it's gonna be a big one. It's a big conference. It's usually a big conference. Um, but the guy who started it is retiring, and Tim Mai is taking over. Tim Mai
Oh, I
purchased
know
the company.
Tim. Yeah.
Yeah, Tim purchased the company. So, because David Lindahl is retiring. Um, and what else? Like, if you want to get the course for RV park, Bob has a course. Reach out to Bob or reach out to me. I'll connect you to Bob. And if you're looking for a virtual assistant, reach out to us. Support me on LinkedIn. You guys know I support on LinkedIn. And then I have something coming in, guys. I'll let you know. It's not there yet, but we have a program. We're about to start working on a project. You guys will find out soon. But with that being said, let's go ahead and have a picture and end it for the day. Let me close this. Everybody put your camera on and put your best face forward. All right, so let me pull out this. Okay, let's smile. Um, smile.
Oh, sorry.
Okay, Lafleur, you on, but your camera is, I don't know how I'm gonna cut that off.
What
Um,
happened?
because your face not showing in the thing. Let me say what
My face is
happened.
not showing?
No, it's dark.
Oh,
I
let me
don't know if your
see.
camera is even on. Yeah, there you go. All right, let me try one
You
more
can see me
time.
now?
No, we still cannot see you.
It's just a
Your
whole
camera
black
is dark.
screen.
Yeah, it's a dark screen. Okay,
Probably it's the
let me do
room.
this so everybody can get going that way. All right, guys. One more time, smile, and let me pull this thing. All right. Okay. Thank you
Thank
so
you,
much, Erica.
Erica.
It was such a great opportunity to have you here. I enjoy it. I hope everybody did. But guys, there are several things around. One thing Erica said, there's no best way. There's not one way. This is a tool you can use. So if you think this tool may work for you, make sure you use it. We all looking for making things work. That's all it is about. Thank you so much. Have a great rest of your weekend and see you guys next week. Bye.
Thank you. Thank
Thank
you,
y'all. Have a great
Erica. Thank you,
weekend.
All
Susan.
right, thank you.
Mhm.